Welcome to the Explainer. Right now in the Indian healthcare sector, there's this absolutely fascinating corporate metamorphosis unfolding. We're going to unpack a really comprehensive research report from Mirai Asset Sharekhan to get into the mechanics of a rapidly transforming company, Yatharth Hospital and Trauma Care Services. It's a story of aggressive expansion, a complete pivot in business strategy, and honestly, some pretty intriguing financial alchemy. Let's dive in. Let's hit the ground running with the numbers. A target price of 1,015 rupees. That signals a projected 18% upside potential. The analysts at Mirai Asset Sharekhan have slapped a really firm buy rating on Yatharth hospitals. Now, in a volatile market where healthcare stocks can be so incredibly sensitive to regulatory shifts and capital costs, seeing a conviction rating like this, well, it definitely makes you stop and pay attention.
So the big question we're trying to answer today is this. How exactly is a regional hospital chain pulling this off? What on earth are they doing behind the scenes to unlock that kind of massive growth, justify the target price, and secure that buy rating from top-tier analysts? To really get it, we need to look under the hood of their growth engine and see what the data tells us.
All right, let's jump into part one, the Yatharth growth story and their rapid revenue scale-up. Over the last 4 years, the company has delivered a staggering 40% revenue compound annual growth rate. 40%. That's not just an incremental bump. That's a massive, sustained scale-up. And alongside that top-line boom, their operating earnings, their EBITDA, actually grew at a 61% CAGR over that exact same period. So they aren't just making more money, they're doing it highly efficiently. But you have to wonder, where is all this revenue actually coming from? Well, back in the 2021 financial year, their revenue was highly concentrated around basically just 3 hospitals. But fast forward to the Q3 2026 estimates, and you see this beautifully diversified portfolio spread across 8 hospitals. They are aggressively expanding their footprint and making sure their revenue streams aren't just tied to a single vulnerable location. Which brings us to part 2, expanding the hospital network with a strategic focus on the north. They've built a real stronghold in North India. We're talking 8 hospitals and over 2,500 beds. But here is the absolutely crucial takeaway. 81% of those beds are concentrated in high-potential metro areas, places like Noida, Greater Noida, and Delhi. By planting their flag in these densely populated, higher-income urban corridors, they're basically putting their nets exactly where the big fish are, catching a very specific, highly lucrative demographic of patients. So, who exactly are they targeting? Let's move to part 3, pivoting to premium care and high-value specialties. Historically, the old Yatharth built its whole business on a volume-driven model. They used mid-tier doctors to keep costs low, and they relied heavily on government-linked schemes. It was super cost-efficient, sure, but the margins were incredibly tight. Well, the new Yatharth is a completely different beast. They're making a massive shift to a brand and quality-driven model. They are actively hunting down and hiring rockstar super specialists to bring in those high-paying premium cash and insured patients. They're basically moving from volume straight to value. And the numbers back this up. Complex specialties, things like oncology, cardiology, and neurosciences, now make up 55% of their service profile. That's up from 48%. And it makes sense, right? When you perform more complex, high-value procedures, your average revenue per occupied bed literally skyrockets. In fact, their newer hospitals in the Delhi NCR region are showing fantastic traction right now purely because they're hyper-focused on these high-value specialties. Now, to make room for all these premium patients, they're making a really bold, kind of counterintuitive move. They are deliberately shrinking their exposure to government health schemes. That number used to hover around 35 to 37%. But management's target is to push it all the way down to just 25% over the next 2 to 5 years. Why? Well, government schemes usually mean lower margins and agonizingly slow reimbursement cycles. They want to focus on the much faster paying cash and private insurance patients. Rejecting volume might sound a bit crazy for a hospital that's in growth mode, but here's the so what. It massively improves their financial health. By dealing primarily with faster-paying patients, their working capital days are projected to improve dramatically, dropping to just 62 days by 2028, down from about 80 days in 2025. That means cash is hitting their bank accounts way faster, giving them superior liquidity and pumping up operating cash flow so they can actually self-fund this aggressive expansion. Let's peel back the next layer. Part 4, the high-margin financial engine sustaining all this profitability. Check out this totally surprising metric from the Sharekhan report, 19% material costs. For a lot of pure hospital chains in the industry, material and consumable costs easily eat up more than 23% of their revenue. But Yatharth is operating significantly lower at just 19%. It's a massive competitive advantage. But it begs the question, how on earth are they actually doing that? Here is the aha moment, the secret sauce. Analysts call it their internal medicine advantage. A full 33% of their patient volume comes from internal medicine cases. We're talking about treating illnesses like dengue, diabetes, or malaria. These are cases that require zero expensive surgeries, no high-end equipment like heart valves or stents, and no costly implants. So their consumable costs stay remarkably subdued, which beautifully balances out the heavy investments they're pouring into their shiny new super specialty departments. Thanks to this financial alchemy, their EBITDA margins actually stabilize at a very healthy 25% across the projected financial years. Even as they absorb the hefty upfront costs of opening new facilities and paying the huge salaries of those new rockstar specialist doctors, their smart patient mix basically acts as a shield to protect their bottom line. But hey, no stock is perfect. Let's play devil's advocate in part 5. Risks on the horizon. There are definitely some clear vulnerabilities in this expansion story. First off, even though they're actively trying to reduce it, they still have a 35% reliance on government schemes right now, and that continues to cause liquidity hiccups through delayed payments. Second, buying new hospitals brings serious M&A integration headaches. Upgrading facilities and merging different corporate cultures can easily cause some short-term margin erosion. Third, they are going head-to-head with intense regional competition in the NCR territory from massive established players like Max Healthcare. And finally, the ever-present threat of shifting regulatory policies and insurance guidelines in the healthcare space can always throw a wrench into their margin projections. So where does that leave us? Let's jump to part 6, the final valuation verdict. The analysts at Murali Asset ShareCon conclude their report with this strong conviction statement. They say Yatharth is well placed to continue its high growth trajectory led by sustained healthy utilization and a better revenue mix. Because they've been so successful in executing this very tricky pivot from volume to high margin value, analysts are valuing the stock at 36 times its forward earnings. Make no mistake, that is a premium valuation, but it really reflects the market's confidence in their operating leverage. So we've broken down the data, the pivot in strategy, the secret sauce driving their margins, and of course, the real risks they face. The final question goes back to you. With this kind of aggressive expansion and a calculated pivot to premium care, does this transforming hospital stock actually fit into your investment portfolio? It is a fascinating case study in corporate agility for sure, and definitely one to keep an eye on. Thanks for joining me on The Explainer today, and keep learning.